viewers. Today we're going to talk about this article and all these related articles to it. Basically, a few months back, actually it's about February, March now, everyone started focusing on this discounted cash flow model, that's DCF, saying that Ethereum could go way up to even higher than $10,000, up to $10,500. And people just jumped on it, like this guy here, Sean Puri, in February. He helped light the fire, and he just put out this tweet that, hey, Ryan Alice, and that's the guy that made the DCF model, saying that Ethereum's worth a fortune. This guy, Sean, said, hey, we got to listen to this guy because he's so smart. So who is this guy? This guy is Ryan Alice. He has an economic degree from, I think, the University of North Carolina. But more importantly, he has an MBA, a graduate degree from Harvard Business School. So everyone's tweeting that hey, if Ethereum's worth $10,500 because this guy worked on a DCF model, then it must be worth something. But no one bothered to look at the model. So what I did is I looked at the Excel spreadsheet, and I found some issues with his assumptions. So what we're gonna do today is go over the spreadsheet, but in a different way. We're gonna do it in an intuitive way, without actually going over through the formulas. We're just gonna go through it in a way that we could see why or why not it doesn't make sense. So here's the model. It originally had analyzed total revenues here of about $20 billion, but he's lowered that. But they're even lower now. And how do I know that? I have many examples, but I could just give you one. If you go to this website, actually this one's better here. This one here, this is Token Terminal. It shows you they've had 30-day revenues of $54 million, and we're talking about Ethereum here, but annualized revenue of $657 million. So you can see the crypto winter has been harsh for Ethereum. So this $4.3 billion number, even though it's down substantially from nearly $20 billion, it's still not low enough. So what we need to do is lower that number. So what I'm going to do is divide it by about 3 or 4. So let's do that right now. So if you divide by 4, you get over $1 billion. Okay, so that's not the run rate out of last month. Last month's run rate was lower, but we have to account for the higher revenues earlier in the year. So let's use a $1 billion forward revenues. The other issue I have with the model is that it has revenues turning directly into cash flow. There is nothing else in this Excel spreadsheet, and it has 0 expenses because supposedly blockchain has no expenses. So I'm not really sure about that. I mean, I do understand that the validators have expenses, but it doesn't go into the Ethereum network. But still, I know there are expenses related to running their Ethereum foundation. So I don't think this is correct, but I'm not going to touch that for now. And then there's growth rate. We don't know what the growth rate is going to be, but what we do know is that other level 1 chains, and here, this is what I mean by intuitive, other level 1 chains like generation 2 and 3 chains, these projects like Solana and Avalanche are going to lower the gas fees. So the revenues are going to go down dramatically from the previous year or two. And we don't know if the transactions are going to make up for the lower gas fees. But I'm not going to touch this for now, the expenses. What I do want to show you is, or first, before we go there, I want to show you the expected decrease in price. Already we're seeing a 33% decline in Ethereum's forecast price. Now remember, this originally was $10,500. Now it's $872. I have it highlighted for you. But we're not done yet. The last thing we need to do is change the discount factor. This is an incorrect discount factor. Now this gets complicated, but we're going to talk about it intuitively. So the first thing we need to know is that when you're discounting cash flows, you're supposed to use what's called a WACC. And basically, this is a blended cost of equity plus cost of debt. But because Ethereum has no debt, you what you do is you write out, you cross out the part of the formula that has to do with debt, and then what you're just looking at is cost of equity. So for cost of equity, we're going to go to another formula, and that's this, the CAPM, Capital Asset Pricing Model. And the formula is, and remember, we're going to do this intuitively, the formula is basically the risk-free rate plus the return of the market, meaning S&P, minus the risk-free rate, times B, and B is beta. So if there's only systemic risk, meaning the asset you're looking at is as risky as S&P, you just put a 1 there, and basically it doesn't mean anything. And then if there's an equity, a particular equity, especially like a cyclical company, you put a higher number for B. But if you're looking at a smaller company or a technology company, you have to put an even higher number for B. So when you put a higher number for B or beta, this cost of equity goes up. So the problem is Ethereum is not even a stock, so you're not even a shareholder. So I'm not sure how to even value it, but it's got to be riskier than the typical tech stock. So I'm thinking that the beta's got to be closer to 1.5 or 2 than it is to 1. So my guess is that it's closer to 2. Actually, I would say even higher. But we don't even need to go that high. But basically, when you put a 2 here, or 1.8, whatever it is, you're going to get a higher cost of equity. Now, why is that important? Because it feeds into this formula here. Not this formula, this input. See, this discount rate is basically the cost of equity for a normal corporation, a publicly traded corporation. It is not the cost of the discount rate or cost of equity for a crypto asset. So you have to raise it, and you have to raise it by how much riskier it is than an S&P 500. So I would put in a higher number, like 18% or 17%. But you don't even need to go that high because we're already down 33%. The forecasted DCF is already bad. But let's put 17% and see what happens. So if you put 17%, now watch this cell I11. It's going to go from minus 33% to minus 62%. If we go to a more realistic number to 18%, you're getting an expected increase, or decrease I should say, of minus 66%. So that's what I wanted to talk to you about. This model is very, very loose on assumptions, and it's very sensitive to minor changes in those assumptions. So I'm trying to figure out what this rate should be. Maybe to be more conservative, we should make it 16%. So I can say with confidence that this model reveals a projected loss of 58% compared to today's current prices of Ethereum. So that's all, folks. I just wanted to tell you, you cannot use a discounted cash flow model to evaluate any type of crypto project, even a crypto project that has high revenues, because those gas fees are going to go bye-bye. All right, well, thank you all for listening, and please come back.